This is part 3 of your accounting review, and it's going to discuss the lifeblood of the business, its statement of cash flows. Cash is king. Cash is life. Without cash, payroll can't be met, vendors can't be paid, and bankers can't be paid, taxes can't be paid, utilities can't be paid. Gosh, the list gets pretty long, doesn't it? And you know what? Cash is the most important thing that a business can use. So let's look at the cash flows. Cash flows occur in 3 separate categories. We have cash flow from operations. That's the actual thing the business does. If you're selling peanut butter and jelly sandwiches for your business, that's the operation. Investing is cash that goes into and out of investments. Sometimes if you got some extra cash, you might invest, and that can be used to generate some income. Meanwhile, the outflow of cash to the investment has to be weighed. The third element is cash from financing. Financing is borrowing money from the bank, acquiring money from investors through sale of stock, the paying back of loans, and also the return to stockholders. So those 3 elements we will look at. Now remember, the fundamental issue about cash flow is that cash flow, net cash flow, equals cash in minus cash out. And if you want your business to be successful, you want net cash flow to be positive, which means that cash flow in must be greater than cash flow out for that to occur. And the financial manager of the firm takes the steps through the management of cash flow to try to achieve positive net cash flow by making cash coming in exceed the cash out. That is the art of financial management. So, let's look now at the operating cash flows. The PowerPoint sort of gives the element, and as you look at your operations cash flow, the accountants give us a methodology for determining that. Quite simply, we start in operating cash flow, we start with net income, or your earnings after taxes. And what we do then is we add back in depreciation. This is an important thing to do because, as you recall from the income statement, depreciation is taken off from sales in order to get eventually to our earnings after taxes, or our net income. But depreciation doesn't really represent a flow of cash. It's only a bookkeeping methodology to estimate the expended value of an asset. So we're going to add back in the amount of depreciation because that will actually represent the cash that's coming in. Depreciation is not really cash flow, but it's taken off of that. Add it back in and you get the cash flow. And then to represent changes in that cash flow, we look at several changes in cash. And those changes include changes in accounts receivable. For example, if last year the people who purchased from me owed me $1 million, and this year at this point they only owe me $900,000, that means I've received an additional $100,000 in cash from the people that owe me money. Similarly, if I owe my vendors in accounts payable $1 million last year, and this year I owe them $1.1 million, that means I haven't paid them that extra $100,000, which means $100,000 of cash that has not gone to my business. So gone from my business. So we have to look at the changes in cash flow in order to find the net cash flow from operations. So these changes in cash, and I have to do it intuitively. I have to think, well, is cash going out of my business or coming into my business as these changes occur? But the changes that occur are in accounts receivable, in inventory, in accounts payable, in prepaid expenses, in accrued expenses. And from our 5 elements of current assets and our 3 elements of current liabilities, these are the ones that impact operating cash flow. When I take all the changes that occur in these elements and add it to my net income, which is the cash that came in on the income statement, adjusting for the depreciation which didn't represent a cash flow, I get my net change in cash flow from operations. Okay. Cash flow from investments is pretty interesting. First of all, change in cash flow in investments. If I bought stock, that's cash out. If I sold stock, that's cash in. If I buy an asset and then for an investment and later sell it, those would represent cash out to buy, cash in to sell. If I receive a dividend from an investment, that represents cash in. So changes in investments, and then changes in plant and equipment. If I buy a new delivery truck, that's cash out. If I sell a used delivery truck, that's cash in. So that all represents changes in cash flow due to investment. And you'll notice that plant and equipment counts as the investment. These are the fixed asset portions for the business. And then cash from financing is the third element that we look at. So it's the change in bonds payable. And preferred stock dividends. Those represent the changes. Of course, a bond is another word for saying a loan. If I get a loan from the bank, I'm essentially getting cash from the bank and giving them my bond that I will repay them. So that's financing. Then we take all of these elements and put them together, and we get the net change in cash in the business. And as previously indicated, I really want that to be positive. Okay. Now, one element of cash flow is called free cash flow, and that's the cash that is available for something else you want to do. So free cash flow is a pretty important measure. Free cash flow is equal to the cash flow from operations minus capital expenditures minus dividends to preferred and common shareholders. That's the amount of money I got available to do something with. Say I want to go and acquire a new business. That free cash flow is what might allow me to generate the ability to borrow money from a bank to support that. So I can say, can you make the payments? So financial statements are very important. I like that little Dilbert cartoon. that you'll see in the PowerPoint. Our shareholders are suing us for misleading them about our financial problems. Since when is it illegal to shaft innocent people for personal gain, says the pointy-haired guy. The CEO says, don't put that in the minutes. And Wally, of course, our ever-present nemesis, says, I'll see what I can do. Well, cash flow becomes essential. Financial statements give us the picture of the business. The financial manager interprets that picture, and, well, we hire the accountants to build the picture for us. We just have to understand what it's saying. The picture can be distorted, however, because inflation gets in there and can change the current value of an asset, for example. Depreciation can distort the picture because, as we saw in cash flow, depreciation helps us on our taxes, but it doesn't really present us a cash flow picture. And the other thing that can present distortion is that good old thing called fraud. Enron is probably one of the best examples, along with another famous chief executive officer, Bernie Ebbers, who was founder and creator of WorldCom, which at the time was the largest telecommunications company in the world, at least on the books. So financial picture is important, yet it can be misleading. Hopefully, as you look at this, you'll find out that you don't know nearly enough about this. The only way to work to develop skill with financial statements is to use them through the exercises to help analyze the business. And that's why, well, many of the homework problems will give you that chance. Keep at it. I personally took several years before I developed sufficient understanding of financial statements so that I can see the picture of my business, I can see the picture of other businesses as I go about my consulting job, and hopefully my experience can help you understand financial statements a little better too. Hey, hang in there. It's getting better.